welcome back to Wham, which is Whatever in Mortgage, formerly known as Wine in Mortgage. But some of my friends like whiskey. Some of them like just water or wake-up juice. So today we're with our wake-up juice because it is 10:30 in the morning.
Yes, a little early.
So we decided to be good. So grab a seat, grab your whatever in your cup, and listen to us as we talk a little bit today in the lending world side of things of real estate. Because we talk everything here about real estate, everything in between. But today, I got my lender buddy with me, Paul Sellers. So I'm going to let him introduce himself. You guys already know who we are. Jen.ray, I'm a lender. We know this. John Duncan, he's with Tejas Imagery. He is an amazing drone flyer, photographer, videographer, all that. And then Benny, my little humper, which I'm going to buzz.
Yeah.
Because he's really taking a liking to Paul. So.
Yep. I'm a dog lover.
Right.
He's definitely a people lover.
Yes.
There it is.
Yeah, there's a little shock.
There went. We had to turn
There
it up. There went. I saw.
Yep.
Now, just for the animal lovers out there that are going to hate.
It's just a buzz.
There you go.
It's just a little.
Not a shock.
It's not a shock. This is not a shock collar. This is just a little. Zzz, so he knows not to hump my.
Although
friends.
my thing is, I think we should have shock collars for kids.
Oh, so it could save their life.
Sure.
Sometimes with Brayson, I'm like, I wish
Go
I
lay
could
your
just-
butt down.
Yeah. Wouldn't work.
No, it wouldn't.
All right, Paul, tell us who you are.
All right. My
Tell us
name is
about yourself.
Paul Sellers. I work with jen.ray. Live out in Katy. Been in this industry for a long time.
Long time.
Long
He doesn't want to
time.
age himself, but it's been a long
It's about 3
time.
decades. So,
So,
I've seen everything in this market.
And I call Paul when I don't know what I'm doing.
Yeah.
I'm like, Paul, what the hell is
okay.
this? What is
I like
this?
it.
Because I know he's seen it before.
Yes.
So, anyways, we didn't have an idea. We were just kind of free flow on this. But I think what we should talk about is, why don't we start off by, since we're both lenders and we both have been going through this lately.
Yep.
Let's talk about when you pull your credit. Because you have to pull your credit when you
Yep.
apply for a mortgage.
Yep.
And then all of a sudden, you get all these robocalls
Yep.
from random people. And then you call the person you applied with and you're like, why are you selling? We do not do that, do we, Paul?
No, we do not. Those
And
are-
me and Paul are part of the activists lender group that's like trying to make, because it sounds pretty illegal, but it's the credit unions.
It's
Right?
yeah, they're trigger leads. So it's the credit agencies that are selling your information, and they're
See-
selling all of it. You know, it's
All
your
of it.
name, your address, your social, your date of birth, your
Which
employment.
seems illegal to me.
It seems illegal.
It's-
It's
but-
privacy violation.
If it's
But
not, it should be.
there's a gray line apparently that the
Yeah.
credit unions are getting through. But yes, we as lenders, we have a different law like for us. So we don't sell your
No.
information. We can't sell your information.
No, we can't.
We can't even talk to your realtor about your information. So when they're like, "What's going on? Why isn't it closing yet?" We can't tell them it's because you just bought a new car.
Yeah, and one of the tricks that we're doing right now is we're doing what's called a soft pull. So when you do a soft pull, that means that we're not running your credit. We're just it's basically it doesn't affect your credit. No one knows that you have run your credit, and therefore you don't get any calls, and it doesn't affect your credit.
But now, even if you do a full pull, you were saying this last week, because it's for a house,
Yeah.
that's a totally different, that
Yeah.
looks totally different
It
than
does.
if you're buying a car or a motorcycle or
Generally,
whatever.
the difference is because we have the money that we lend out. When you go to the car companies, they don't have the money, so they go to different lenders all at once, right?
So the way the credit pulls work, as far as affecting your score, is that number one, there's like 80 different credit scores.
Sure.
For each of us,
Yeah.
depending on the purpose. They know the credit bureaus know that they encourage you to shop for a
Right.
mortgage.
Sure.
Yes.
So usually it's 30 days that if anybody pulls your credit within 30 days, your score doesn't change.
Right.
I thought it recently went to 60 days.
I don't know. I didn't hear that.
Just keep it under 30, you're fine.
Yeah. And there's one that's 15 days.
Okay.
Yeah.
So that's why I always just say, okay, 15 days, your credit doesn't affect it.
Right.
When you shop for a car, when you go into buying a car, before you know it, you have 30 people pulling your credit.
Yeah.
Yeah.
So the credit bureaus know that, so they treat that as one.
Okay.
But it's when you go and you apply for credit cards.
Credit cards, personal loans.
Yeah.
Yeah, because then they say that, okay, if you're applying for 3 or 4 credit cards and
You're looking for money.
you're looking for money, so something is wrong.
Now, does that include HELOCs?
HELOCs is, if it's done, it will be as a mortgage.
Okay. Okay.
So it'd be the same pool as a mortgage.
Yeah.
I think
Gotcha.
it's mostly
Interesting.
like secured loans are easier on your credit than say an unsecured loan. You just are like it's almost like you're going to advance cash
Right,
to
right.
find money. Like
Yeah.
the system
Yeah.
knows this person
Yeah.
needs money badly.
Yeah.
And I tell people generally you'll see more of an effect on your credit if you were denied multiple times. Like if you're withdrawn, there's a difference between a withdrawn application and a denied application, right?
It's not gonna that's not gonna be affected on your score because the credit models, they don't know if you've been denied or withdrawn, but they're looking
Okay,
at
so
the
that's a myth that I've always thought. I always thought that once if you're denied like that, it's like
No.
you're constantly you're still
No.
looking and
Really?
they're judging it by
That's good to know.
the amount of inquiries that you're doing.
Sure.
look at
You
that.
know, and it's like, you know, one of the things I always tell my customers is like, hey, if you go to Walmart or TJ Maxx or Kohl's and you're coming up to the cashier
Yeah.
Yeah.
and they
Yeah.
go, hey, we'll give you 20% off for this purchase
Tell
if you
them
get
I'm
our
buying a
card.
house. I can't do it.
Don't do it. Don't
I
do
can't
it.
do it. I'm buying a house. That's what I say, and then they
Yeah,
stop.
Yeah.
it's just it's first off, yeah, you're getting 20% off, but why are you getting 20% off? They want you to use that card, and then they're going to get you on the interest.
The interest. 'Cause
And-
there's probably some sort of a
There could be an annual fee.
I was gonna say annual
there's
fee,
there,
yeah.
there's something about it.
They're
so
going to
you-
catch you on the back end.
Yes,
Yeah, one way or
yeah.
another.
Things don't exist to not make money.
No.
Yes. that is very true.
But you see why I asked
Yeah.
him?
Yeah,
Because, like,
totally.
see, now I know because I always thought if you were constantly denied, I thought that the denial of an application would actually affect your credit.
No,
But it doesn't matter.
That's
Just
interesting.
late payments in history, Chris.
I thought the same thing. I really
but
did.
I do know that late payments are way harder than if you're maxed out. It's a hard comeback. Like sometimes it'll take you years to come back from a late payment if you don't have a lot of credit.
late payments. It's about 6 months. Yeah, depending on the rest of your credit, it's not. I've seen it just depends on the credit and depth of what it looks like. If you have very limited credit and you have a late payment,
That's
meaning
what I'm saying.
if you have one credit card
You
and
make one late
and
payment.
you don't have a lot to show on your credit report, then it does.
Yeah.
It takes
It
a
will
lot
affect,
longer.
but I've seen it to where a late payment, if you have a couple of credit cards, you can come back from it, but
Yeah,
it
if
takes
you've got, like,
6
five-
months.
If you've got like 5 credit cards, right?
Yeah.
You've got at the end of that's 60 payments. So 59 out of 60 is a lot different.
Yeah.
But if you've got one because we've talked about this before. If you've only
Yeah,
got
yeah.
one credit card and it's 11 out of 12, that's very different. Like it's much, and they want that on-time payment to be like 98% or above.
Yeah.
So that's what I mean. Like that's why they tell you to get those credit cards. Like get that $150 credit card that you put the money for, just to show payments and stuff like that.
Yeah.
I'm not talking about us that are like that. We have multiple
Yeah.
credit, but I'm talking about those newbies, my first time home buyers that like just don't have a lot of credit.
Hey, you know,
Yeah.
it's interesting you talk about that. My wife, when we first got together, she had no credit at all.
Yeah.
And she had
No
just...
credit's better than bad credit.
I don't know. Oh, yeah, totally. But she still... She couldn't get approved for anything with no credit.
Really?
Nothing.
Like they wouldn't do non-traditional? Is mortgage the only one that kind of does that?
Well, I mean, not necessarily for houses, but I mean, just for like anything really.
That's
And,
what I mean,
so, you know, what we did is we got her on one of those
Secured cards.
prepaid
Yeah.
secured cards.
Yeah.
Started with that.
Yeah.
You know, and then next thing that built her up a little bit. And then we got her one of those little $150, $200
Yeah.
credit lines, and
Yeah.
she would buy something every month and then pay it off.
Yeah.
You know, now she's got, I think her credit score is like it's
800
over
at least.
800.
That's good.
Yeah.
That's really
so,
good.
I mean, we brought her a long ways.
Yeah.
You know
But-
the worst thing that people with bad credit can do is like they freak out and they just close everything. Like,
Yeah. Yeah.
Now I have nothing to build your credit with.
Right.
Like, don't close your accounts. Just never open new accounts. Just keep the ones that you've had since you were 20 and first opened them. Like I still have my first Capital One card, and the limit
Really?
has increased. Yeah, I've never closed it.
They had Capital One back in the...
Stop it.
Yeah.
Stop it. Paul's here. I'm not
I'm
there.
gonna get beat up
Yeah,
in a
I had
minute.
Capital One. I don't even know what my first card was. Citibank was my
Citi.
first card.
Citibank.
I think everybody had a Citibank.
Well, I did. My first
I think I still
card-
do.
My first card that absolutely destroyed me because I was just young and dumb and like away from my parents. I was in Cali, living my best life.
Don't tell
Yep.
me. Let me guess. Capital One.
Discover.
Oh,
No.
okay.
That's
I
why
still
my
got a
first
ca-
next card was Capital One.
I still got to discover
Yeah.
too.
So,
Anyways,
but I think, I always say this to people and my customers and everybody that I talk to is, if you're thinking about buying a home,
Mm-hmm.
it doesn't matter if it is tomorrow, 30 days, a year, 2 years, 3 years. You need to know, you need to talk to a loan professional,
you do.
and you need to look at your credit.
Yeah.
It doesn't matter if it's a hard pull, soft pull. We have to look at it because first off, you want to see what your score is at.
Mm-hmm.
You can go and you can look at Credit Karma or annualcreditreport.com, but the scores are not right.
Right.
Very off.
They're
Because
very
I will
off.
have people
Well,
that think they are.
Is that not true? Depending on if like you use TransUnion or
not.
don't they vary some too?
No, because the model that they use is as if you're getting a credit card.
Oh, okay. Okay.
So the scores are
very off.
They're very
my
off.
Credit Karma is it doesn't report half of my stuff. Like it doesn't. You know what I mean? I know for a fact it doesn't have 2 of my credit cards on there.
Yeah, I mean,
Because you can dive into Credit Karma.
is Credit Karma is good to see what is on your credit, but not for a credit score.
Yeah, determining.
And
Right.
we have like if you do even if you do the soft pull with us now,
Yeah.
we can do the rapid rescores and we can
Yeah,
see
I've done
what
a
your
lot of
score. Okay, if you do this, this, and this is what will happen to your credit.
Okay, stop. What is a rapid rescore?
Rapid rescore is if Paul was coming and he was applying, he would apply,
Okay.
and I would look at his credit score, and it's like, hey, we're at a 690, but if I can get you at 720,
Oh, gotcha.
we're going to have a much better rate. We're going to have a much easier loan process for
Yes.
you.
Okay.
And sometimes it's not just the rate. It's like you want an easier loan process with,
Makes
with
sense.
good credit. So what we'll do is I'll say, hey, look, I'm looking at your credit, and we have like a simulation type
Yes.
of thing that we can say, if we paid this credit card balance from 10,900 down to 3,500, your credit score is going to go up by
Yep.
20 points.
Right.
Yep.
And
Right.
if we take this old one that's been there about 6 years, it's not kicked off yet, but it went into a collection, or a charge off. Take that, go back to them and say, I'd like to take this out of charge off status, pay it off. Sometimes they'll take 50% and they'll settle with you. Pay it off, take it out of charge off status, and we can slip it into paid derogatory.
Yep.
That is much better. Charge offs are horrible. It means you did not care.
Yeah.
It means you said, I borrowed money from you, even though I'm able to pay you back now, I don't care. That's what a charge off essentially says to the credit bureaus. Because usually if I take charge offs of people, it
Really?
right away helps them. Yeah. And it's usually old, stupid stuff. Like a gym membership.
Yeah.
You know what I mean? Just dumb stuff, but it hurts. It really
Yeah.
hurts.
I mean, it's important that a lender looks at your credit and they can say, okay, what's on there? Is there an old apartment that you left, and then all of a sudden they're charging you $5,000 because of incidentals,
Right.
Or an old
is it
Comcast.
which are hard to get off, or it would be in building somebody's credit, because I've seen it to where someone has very limited credit, they just don't use credit cards, and they have old bad credit, but they don't have any credit
new
cards.
stuff.
And if you put a credit card on there, it actually will increase their scores by 30, 40, 50 points.
Wow. Right.
Yeah.
Right.
Credit's sort of like, it's like a tightrope.
Yeah.
You have to stay on the rope and just get really good at balancing it. Because
Yeah.
if you just don't go on the rope, there's no way you can build back from bad credit.
Okay.
Like you have to open new credit to build.
So, question, and I've heard both sides of this. I've heard yes, it does, and I've heard no, it doesn't. And that is medical bills, outstanding medical bills.
Okay, so medical
This is
debt,
interesting,
they
actually.
changed the laws within the last year.
Oh, really?
Yeah.
Okay.
So a couple of things. Number one is they cannot put it on your credit
Correct.
6 months after. They have to wait 6 months
Okay.
from the date that it was due to 6 months later. So if you had services in January, they can't send it to collections until
Right,
July 1st. That's number one. Number two is supposedly if the balance on the debt is less than $500, they're not supposed to report it to the
At
credit.
Really? Okay.
Third is, let's say you have a $5,000 balance on your medical debt and you settle it for $2,500. Now it's paid. They have to take it off your credit.
Really?
You have to. Yeah, it's a little, medical is a lot different than.
Medical is very easy to work with. There's just ways you just have to approach it.
I got you.
And it's number one is don't admit that it's yours. Call the collection agency and say, what is this? I just pulled my Credit Karma and I saw this. Yeah. What is this? I don't know anything about it. So you make them prove that it's yours.
Sure.
Then once you say that it's yours, then you go, oh yeah, okay.
Yeah.
So you just go down the line. You says, oh, I thought my insurance covered this.
Yeah.
And you make them work to make sure that it's yours. And then once they say that, okay, it is yours. Oh, I didn't know. I'm willing to pay it. Are you willing to take 50 cents on the dollar? Yes. Before you pay it, you get a letter from them stating that if you pay it, that if you can take it off the credit. So that's the letter. And then you can send that to the bureaus and they'll remove that credit off. Versus if you don't get the letter and then you're reliant on the collection agency to remove it, good luck. Because
the collection agencies are in the business of collecting money. They generally are not in the business of helping you fix your credit.
No.
If you want a credit restorer, we have people for that.
Yeah.
Do you have a credit restoration person on hand?
Me.
You? Well, I'm the quick fix. I give them the quick fix. But if I see it and I look at it and I'm like, there's no way. You need a credit restorations person. I have a gal by the name of Louisa Deason who I'm actually going to get on this podcast. She is by far the best follow-up, because you'll send people to credit restorations all the time, and it's generally not that the restorer is bad at their gig, because they're all good at it.
Right.
But Louisa has a way of making people understand, no, you have to play. You have to do it. Because, everybody says, well, I'll work on it and I'll get back with you. And then a year later, same credit score.
Yeah.
You got it. So sometimes if you're early enough, if quick fixes like Paul and I can't fix it, right? Then we'll send you to someone, and it is worth the $200 they might charge you a month, because at the end of the year, what is that? $2,400?
Exactly.
Yeah.
But you have way better credit. Like sometimes, because there's some that are pretty bad.
It's I think in hiring any credit restoration, you have to say what's their strategy. Sending disputes to the agencies, that doesn't work.
Yeah.
Okay.
Because Congress basically passed a law, I think it was last year, that they can, the banks and the agencies, they can disregard the dispute letters.
Really? So the credit restoration is it like a dying business then? Or is that affecting it?
They're not. They don't have to react to the if it's coming from a credit repair company. They don't need to respond to those letters.
Okay.
Really?
So somebody who's at a 540. I know as well as you know that's not a quick fix. What do you do? So because sometimes I'll be like, look, this is going to take a couple of years, and if you don't want to use a restorer, we can be on this system together, and I'll check in with them and say, did you do this? Now we need to do this. But it's those. It takes a long time.
Generally is within. I believe that if you focus on something, it expands. So if you focus on your credit and you start paying attention to it, it will improve or expand. And a 540, you can look at a 540 and you can within 6 months you can have that over 600.
I do tell people the number one thing you have to do though is you have to call the people that you're either in collection or you're default, and you have to say, I want a payment plan or I want to pay you off. Like you have to make that first call, right?
It's
okay.
The first thing you got to ask is,
like student loans.
It's like
child support.
Yeah.
Those things that.
I think what it comes down to is that you have to. The first thing you got to do is you have to assess. Okay, what got me into this situation in the first place? Is that fixed? Because if it's not fixed, it's always going to be a problem.
Ongoing. Yeah.
Is that if you're short on money every month and you're not able to pay your bills because you're robbing Peter to pay Paul, no matter what you do, it's going to be bad. And if you hire a credit repair company, you're just going to throw away another $2,400 in that example, because of that.
Right.
So what you have to do is you first off is you have to resolve, okay, what is the core
the
problem, and is that fixed? And then once you have that, then you look at it and, okay, what is the strategy on the credit? You know, what is showing up on there? Is it medical debt? Easy fix. Is it credit card debt? Easy fix. Is it the mix of your credit? You know, and you need to put credit cards on there? Easy fix. You know?
Would you recommend, because I see some people that don't have a lot of credit, they'll self-report, like their utility bills and stuff like that. Does that, because I see that on a lot of people, and I don't know on the back end, what kind of help does that do? What does that?
It doesn't do anything because it's like having an authorized user account.
Right.
You know?
Yeah.
And that, you know, people use, so that would be like if I have credit and my wife doesn't, and I want to build her credit, and I just add her name to my card. That's an authorized user.
Right.
So that it doesn't help your credit, and it's utility bills. You know, so
Right.
for some things it might work, but on a mortgage, I've been told that it doesn't really add that much to it.
Yeah, I want to do more research on that because I feel that so many people do it. Somebody's telling people to do it, and I'm like,
Well, it's
like
echo.
how much does it affect it? You know
It's
what I mean?
what is it? It's
There's a lot of people who do it.
Is it Transfusion Boost or Equifax Boost? It's one of the
Equifax, I
agencies.
think it's Equifax Boost.
They do a boost, and they're the only ones that do it.
Yeah, so your middle score is still your middle score.
You know, so it's that could be dangerous too. Is what if you get past due on your electric bill?
Yeah, you know what I mean? And
You
then
know, and it's
self-reporting
just
if you're late.
you know, it's just being smart at how you do it, and it's
If you can't pay a bill, it is always better to call cable and say, "Hey, I'm going to be late on this. Can I set up a payment plan with you?" Because those don't report. Don't ever call your car place and say, "Hey, I can't make the payment." They'll be okay with it, but they'll still report that you didn't make the payment.
I'll tell you this is
So that's why you don't want to report your utilities.
the credit cards that somehow they're in connection with each other, because if you call one and you tell them, "Hey, I'm in trouble, I'm in past," somehow
They
the
love it.
others know, and all of a sudden your credit limits start dropping, or
Yeah. Yeah.
your balances or your limits they start dropping, or they start closing your account. I don't know. They really look for it.
I would say too, to anybody who has, like, when people like, if I really connect with like a first time home buyer that's like, they got like a 540, 520, right? And but they really have a good job. They're making money.
Right.
I can see their ratios are really low. In my mind, I'm like, there's a part of irresponsibility in the sense of you don't recognize it, right?
Yeah.
You're going out, you're doing things, maybe you're paying to show off here, you're doing this. It is all when you're like a recovering low credit scorer, it's the same as any recovering addict. Like, everybody's addicted to bad money decisions. So it's like you have to, sometimes, as crazy as it seems, when you're going through any sort of rehab, you change your friends. If you're going through credit, like you're trying to fix your credit, sometimes you recognize you're not hanging out with Bill anymore, because you and Bill were always going out and doing stupid stuff and spending all this money. It's like, "Hey, you want to go on a trip to Cabo?" And it's like,
And Bill
"No,
never brings his wallet.
I think I want to stay here for a little bit and just kind of, you know what I mean?"
Yep.
So a lot of times, as much as we were saying, like, we have to see, hey, did we fix that? We have to say, hey, I truly have a spending problem, so we're not hanging out as much anymore.
I think you hit the nail on the head, and that is where your attention goes, your energy flows.
Yes.
You know,
Yeah.
so you put your attention on your credit, and all of a sudden, a lot of the stuff that like you said, you've been ignoring or taking for granted.
Yeah.
All of a sudden, now you're keyed into that, and you're going to make better decisions.
Yeah.
Yeah.
It's. But if you put that attention on it, you can drastically improve credit.
Right.
Yeah,
Within
'cause let's
6 months to a year.
Yeah, and sometimes that is very true. And I've seen people that sometimes I've worked with people for 2 years and they're finally in a house, but they went FHA or VA, which has a little bit more leniency. But let's say, what would you say? Because people are always like, bad credit, you're just declined, and it's sometimes just low credit that's approvable.
Right.
Is still tough because they're like, okay, this is super risky because they're like 581. They're like the minimum score almost. It's like, so we need 10 months of reserves. We need to show that you have money somewhere. So generally, if you have credit issues, just the better your credit, the less risk you show and the less things that the system that we use to approve you is going to require, right? It's not going to require that.
Interesting.
Yeah, because I'll tell some people, I'm like, I have you approved, but in order to be approved, I'm going to need you to find someone, like your mom or dad are going to have to give you a gift, because we can't use your money for the down payment.
Yeah.
You're going to have to go down payment assistance or get a gift from mom and dad, because we need you to have that money in your bank as reserves because your risk factor of the credit, right?
Yeah.
I mean, because what are other things that come up on low credit? You got reserves, you got what you can actually afford. Sometimes your ratios, if your credit's low enough, they'll say, okay, we can't go up to, we need your back end to be at 36 rather than 45 or 57, right?
You know, when you have the lower scores, is I think that's where you have to have even more of a conversation with the lender, and just and you have to show the documentation, and you have to look at things, and you got to play around to see what works. You know, because what will work for one person might not work for another.
Right.
You know, I've seen it to where everything is in line. We have the reserves. You know, we have the income, but for some reason it doesn't like it.
Exactly, and that's what I mean. Like, because I've had some people who will have a bit of frustration, which I'll talk them through.
Yeah.
But if you've ever applied or done, because we're not only in the business of getting people in homes, we really are in the business of people generating wealth in their future, right? We want to get you in a home.
Yeah.
We want you to have good credit. We want you to know what equity is, so that your second time, and like, you know, kind of like the paperclip effect.
Yeah.
But sometimes it's like people who don't have a lot of debt but have low credit, because they don't have enough credit to kind of build it up, they won't understand why they can't afford what they thought they could. And that's what I mean by, if you're a credit risk, sometimes your ratios will go from, 30-57, sometimes 41-57, which is front and back end, and they'll say, no, we need them at 25-36, meaning we don't want their house payment to be over 25. Benny, are you so excited about credit, dude?
He is. Yes, he is.
Yeah, I got the right one.
But like 25% they don't want any more than that going into your house payment. And then Benny, buddy, this is going to be a lot of editing, bud.
Yeah.
Do you have why does he like you so much? It's usually girls he's into.
I guess I'm a girl.
Benny,
He's eating your mic.
No, you get down.
I got 2 dogs.
You get down.
That's all right.
You sure?
Yeah.
All right.
Make my dog jealous.
But yeah, that's what I was saying though. Just like the credit is more than just your number. It's more than just the number.
You know, what I find is that, if you have limited credit, you make good income, and you don't have a lot of savings, that's almost the same as, you have a lot of credit, because the thing is you don't know where your money is going. Where is it going? Is if you're making $200,000 a year, how come you don't have $5,000?
Dude,
right.
That's almost what, $18,000 a year or a month that you're making, and you're spending
all of it.
And where is it going?
Multiple times. So the more money, the more problems. It is true.
Yeah.
The more money people make, they just create a lifestyle where they absorb all of that money. Where you look to your spouse and you're like, where the hell's all our money? And then, you kind of recognize. Okay, Benny, you got to get down, bud.
Go. Here. That's not working.
There we go.
There it goes.
Sorry, bud. You know better. Nope. He didn't do it. It was me.
I didn't do it.
You stay. Thank you.
That wasn't me.
We love you, Benny, but not during film time, bud.
Yes.
Sorry for all that.
It's when you have that conversation, the conversation that you need to have with your lender is, one, it's about, your credit. That's a big piece.
Mm-hmm.
The other part of it is, your budget, the B word.
Sure.
Yeah.
Sure.
It's where is your money going?
Mm-hmm.
And it's, you have to have these discussions, because no one really has these discussions with you, and they're uncomfortable, and they're tough questions.
Right.
So it's going through and really looking and evaluating and says, okay, here, what, you making, $10,000 a month, but you only have $1,000 in the bank, and on your credit, it only shows that you're spending $2,000.
Yeah.
So where's the other $8,000 going?
Right.
Yeah, like, what are you doing?
The last thing I would think that any reasonable lender would want to do is put somebody into a difficult situation.
Yeah.
Oh,
so,
yeah. Well,
yeah.
by
And
law, we cannot. We
Right.
can't. There's things that we cannot do. If it doesn't make sense and it doesn't look like paybacks there, it's not us being mean.
That's the whole fiduciary aspect. Right?
Yeah.
But
and
we want you to get the loan because that's how we
Absolutely.
get paid. But if you can't, you just can't.
But maybe
It's-
choose a little bit less of a house.
yeah, it comes down to, can you afford it?
Right.
Payback.
And it's, like right now, if you're paying $1,800 and then your mortgage payment is going to be $2,500,
Yeah.
and you're not able to save,
Payment shop.
and how are you going to be able to afford that other $700?
And-
That's a big question.
Yeah.
And we also do your income base before taxes. So there's
And
that.
I can
Yeah.
I can see that being hard for you guys because
Yeah.
most people have a stay out of my business mentality.
Yeah.
I know what
it's
I can
harder to
afford,
open
you
up
don't,
to
all
a
this kind of
lender
thing. But
than a realtor.
the truth of the matter is, because I've been there. You're thinking as you go into this loan, well, I can get a part-time job and I can.
Yeah.
No,
No, there's reasons for the rules that we have in place because
Exactly.
it's failures that
Yes.
happened in the past.
Yes.
Yeah.
Like a lot of stuff that's happening now is because of the way lending
Something.
was in the early 2000s.
Right.
People like foreclosures. The more foreclosures that happen, the more rules you're going to see.
Yeah.
happen
Oh,
within-
totally.
And if you look right now, actually foreclosures are at a record low.
Yeah.
yeah, really,
Delinquencies are at a record low.
Yeah.
I did
because
not know that.
Because we have changed.
because of what happened back then.
Well, there was a time where the margins, everything got really sticky, and it got really hard. Well, I would say a couple of years during COVID. It was really hard. One, people were losing.
Well,
their
they did the
jobs.
modifications and stuff like that, but
Yeah.
but the modifications and the forbearances,
Right.
that's where the bank, if you're in trouble or whatever, you call them and
Tag
they'll
on
work
to
with
the-
you, and they'll either put the payment on the back of the loan,
Yeah.
or they'll give you like 6 months to get things up to
Sure.
speed, and then you have to repay it back. Those are forbearance and modification.
There was. I think that the guidelines got a little stricter a couple of years ago. Don't you think? Maybe they've laxed off a little bit, but I think they're
I
much
think-
stricter than they were back in 2015.
It's I think yes and no.
Yeah.
Because I think they got stricter by the fact that you had to verify your income.
Okay.
Yeah.
That you had to show you can't. There's certain things you can't see in a bank statement.
Sure,
like
sure.
non-sufficient funds, insufficient funds.
Mm-hmm.
There's a lot of things. It's just, what has changed is that you have to verify everything and you have to explain everything.
Right.
As I write, besides, having math problems all day long, now I have to write book reports. I have to write letters of explanation for this or that. I have to
Yes.
explain everything,
Mm-hmm.
and I never
And
had to
people
do
freak
that.
out when they got. They're like, "Why do I have to do that?" Like, trust me, everybody has to do a letter. You're fine.
It's it's that's more of what you're seeing, and because of that, the file quality is better, and they're performing.
Sure,
Mm-hmm.
sure.
And it's where they start loosening those guidelines, where the foreclosures start happening, because then you get people that can't afford the house,
Right.
Right.
and that affects it.
And it's and again, going back to what we were saying earlier, it's not always the fact that you don't make enough money or your credit's not high enough.
Yeah.
Sometimes it comes down to you just spend too much money frivolously, and you may skip a payment. So, because there's been plenty of people who have great credit, have a great job, and they're like, why am I being declined?
It's your YOLO mentality.
And I'm like, I was like, what I would do if I were you is I would trade in the Lexus for a cheaper car.
Yeah.
I
for
would
real.
get rid of the Sea-Doos or pay that off. The golf cart payments, you only owe like $1,200 on. Why don't you pay that off? And then we can afford. Because sometimes people who make a lot of money, they have a lot of toys.
Yes.
And they don't realize
Yes.
you're just as strapped as your neighbor who lives in the same size house as you but makes $50 a year.
Yeah.
Like there's some people who are just really good with their money.
Mm-hmm.
So I mean, you cannot tell. There's no way you will ever know what your neighbor makes.
Right.
You just won't.
It's
because you don't know what they spend their money on. You
Sure.
don't know what they got in the bank.
so like what I always tell my customers is like, having when you listen to the conversation that I'm having with you, listen to the conversation that we're having right now.
Mm-hmm.
This is the way a conversation has to be with your lender.
Yeah.
This is your conversation. It has to be with your realtor. It's not what's your credit score, what's your income, how much money do you have down.
Right.
What's your profile look like?
It's more. You got to feel there's got to be a conversation. What are your goals? What are your short-term goals? What are your long-term goals?
Interesting.
Where if you're right now you're renting $1,800 and it's going to $2,500, what are you going to do about it?
Yeah.
Is if you're making $200,000 a year, why aren't you having money saved?
Right.
And it's a lot of bad lenders, a lot of the online lenders, they don't want to have these conversations.
They really don't.
Right.
And it's
really
all they
don't.
want to do is just get you into the house.
There's
The
not
builders,
connection.
lenders, they're giving you a lot of money, which is great, but what
Are
aren't
they
they?
explaining those taxes to you?
Yeah, and that's a big one,
That is a huge one.
and that's what you look at, and
Yeah.
and you have to value that,
Yeah.
and if you don't, that's where the trouble happens, and then that's where all the bad experiences with the lender comes into play.
Mm-hmm.
It's not, it's they're not getting the full story,
Right,
and
right.
that's the issues that I see, or I'll see, I'll get a contract, and they'll say, okay, we've got 30 days to close. Then I look at it and I go, oh my God, there's issues, and you have to battle it, and you're trying to make it work, but
But you and I both are pretty good at that because you and I have called each other and been like, "There's this. How should we kind of go about it?" But you generally, like our realtors, we have such a connection with them. We're like, "Look, I know that this is closing at the end of the month, but I'm gonna be real with you. This is down payment assistance. There's a gift. There is a bonus that they're expecting. Like there's a whole bunch of stuff that's like kind of snowbally." So if it doesn't close, just make sure the listing agent isn't going to have a freak out session.
Yeah.
So, because the best thing is to be honest. Yes, I will absolutely try to get it closed by the end of the month.
Mm-hmm.
Absolutely. Because again, we don't get paid until it closes. So we want it to close too.
Sure.
But if it can't, I don't want it to break the deal and I don't want it to cause chaos. Like just let them know, hey, we're going to try for it, but there's a couple of things that might, because we know we got some chip paint we got to take care of.
On a related front,
Yeah.
I would be very remiss, if I didn't ask this question of you. You've been in the industry for 30 years.
Yep.
So you've seen pretty much lots of stuff.
Yes.
Where do you see us now? And I'm asking this for all my realtor clients out there.
Yep. Yep.
Where do you see us now? Where do you see us going? And have you seen this before?
So a lot of what you have right now is a lot of interference with the Fed Reserve. So it's not really a true market.
We identified that already.
And it's, one of the things is a lot of the Fed Reserves, they're lawyers instead of economists.
Right.
So they're looking at reports. I was on a podcast and this guy said it really well. He goes, Wayne Gretzky was talking about, being a great player. Mm-hmm. And he goes, I go to where great players go to where the puck is, not where it's at.
Right.
And the Fed Reserve they're looking at where we were 6-7 months ago, looking at the reports. So they're misreading the reports.
Yeah.
That's one.
We've talked about that many times. Lots of misinformation.
So what I would tell you is you can't. Right now, there's not a lot of buyers in the market. So there's the listings are starting to increase.
Mm-hmm.
Right now, the sellers.
The listings increasing, but the purchase price is not.
Yeah.
Purchase prices, you're still getting the cheapest house you're going to get.
So right now in this market, you can ask the sellers for more things. You can ask them for a lower price.
Sure.
You can ask them to pay
Concessions.
for concessions. You can go and people are worried about the interest rate. There's programs that you can do where you can get the seller to pay
For the buy down.
for what's called a buy down. So if let's say if the rate is 7.4 right now, that means you can start with 5.4.
Sure.
Next year is 6.4, and that allows you get it at a good interest rate, and then when the market turns, then you can just refinance it at that rate. Great way to do it. And it's just it's people. They're just worried about it's 7.5%, it's 8%, and it's it is.
Yeah, but you're not going to be there long.
No, it's and even
how long do people stay in a mortgage on average? 5 to 7 years.
Yeah. But the bigger thing is okay. Right now, you have the buyers that are out of the market because of the interest rate, and the inventory it's probably like a 2 to 3 month supply right now, which is not a normal market. A normal market is 6 months. And what's going to happen when the rates drop?
Yeah. Oh God, you're going to be giving 40,000 over.
It's asking. So now you're going to have, let's say, a house right now that you can buy it at 300,000, get the seller to pay you $10,000 in concessions, and then when you go and the interest rates drop, and they will, what's going to happen when you go out there? So it's just, the buyer's going to go, okay, I'm ready. The rates are great. Then they're going to look and they go, where are the homes? And then then it's going to be, you're going to get into a bidding war.
That's why I always say, I'm like, it's a wash. Everything, you just got to keep moving. The market will self-adjust to how you react to it. Like, you have to keep moving, because if you wait it out and everybody waits it out, like we just said, then when the rates drop and everybody's like, hey, then you're paying $50,000 more for a house that you could have had for $300,000, which is 7.125. Let's say a 7% on $300,000 is better than a 6% on $350.
Yeah.
Right?
Yep.
So it's like that's what I mean. It's like, get the house, fall in love with the house, and then when the rates do drop, now you'll be in this house, and you are freeing up a ton of money.
Yeah.
Because you can just refinance it.
Absolutely.
So sometimes I tell them, I'm like, look, we could buy this rate down, but if they're not giving you seller concessions, I wouldn't use your own money to do it.
Yeah.
Just wait it out.
It's there's a saying that's called marry the house, date the rate.
Yeah.
And that's basically just what what you said, Jen, is you fall in love with the house, you get it at a good price, and then next year or whenever the rates drop, they will go down.
Yeah.
And you asked the question, how do you know the rates are going to go down? Well, it's
cyclic.
It's cycle, but it's the way that we have to price a loan right now.
I gotcha.
We have to. In the last 2 or 3 years, I've charged more points than I have cumulatively over a 10-year period.
Really?
Yeah.
Never before did we have to charge points. We were able to do reverse. We were able to give them a higher rate and then pay closing cost.
Sure.
It's called premium pricing.
Yeah.
And that's non-existent right now, because what they know is the investor is they know that this loan is going to pay off early.
Yeah.
Because that loan is going to pay off early, they want to have a set rate of return.
Right.
Yes. Because they know there's going to be a refi boom coming.
Yeah.
So if they buy this loan, they're going to have about 2 years of payments. So they want as much money as possible.
Right.
So that's exactly what he's saying. Like people who are like investors who are buying houses for rentals, they're priced off of the charts.
Yeah.
The highest we can give them. Well, hell, it's moved up to 8.125. It's giving me that option, but you're still paying 2 points for 8.125.
Yeah.
We can't give you a 9% so that you don't have to, But investors are easy. I'm like, if the ROI is there, they just buy it anyways. They don't care.
Yep.
But that goes to say your rent's going to go up.
Yeah.
So you might as well buy your own, But,
and that's why I say that it's an incredible time to buy a house right now.
Yeah.
Because no one else is in the market. So when no one else is in the market and you're there, the likelihood that you're going to get a better deal is there. My neighbor,
Right.
They bought, I had a realtor that, she sold the house, maybe 6 doors down from me, and they sold it $100,000 under price.
Yeah.
Oh no.
And that's the hard part for the sellers, and that's I think where that touchy why there's not as many houses as we think, because some of them have only were first time home buyers and they bought it maybe 3 years ago, And they're trying to, they're like,
Yeah.
well, I can't take that big of a cut. Like, I owe that.
But
money.
in that example too, is they
So-
bought the house. Okay, they bought the house for $375 and they sold it for $525.
Right. Right.
Yeah.
So they still made money.
Sure.
They just lost a little bit, but it just it's the timing.
Appreciation will always be there. after.
You know, but
7 years.
I guess the point more there is that there are good deals in the market.
Oh yeah.
For sure.
You know, and it's just not, it's not, you're not buying the house because the rates are high.
Right.
It's that it's just not worth doing, I guess, if that makes sense.
Would it be safe to say that the savvy purchaser is looking actively right now?
Yeah.
Actively, and they're looking
Yeah.
for skeletal only.
Right.
They don't care what the paint looks like.
Yeah.
They don't care that,
Yeah.
Maybe something's got like, avocado tile somewhere. Like, it's something that if you can get
Yeah.
in there and it's got a good, because let's be real, they don't make homes the same way they used to.
No.
So I tell people all the time, and we had this conversation with Caleb and them,
Yeah.
instead of buying new construction, go and find you in an established neighborhood where the oak trees are already over the streets. Like, it's, you know what I
Yeah,
mean? It was
yeah.
built back in the 90s,
Right,
right?
right.
Grab that house, and then when the rates drop, get you a rehab loan.
Mm-hmm.
And freaking make it whatever you want. And you've already got the established taxes. Because
Right.
these construction loans, that mud is
Oh.
killing my people, and they don't realize it. And I'm like, listen,
And they're not getting the quality.
your
And
taxes gonna be
exactly, and that
$800
mud
a
has
month.
no exemption.
Yeah.
It's there's no exemption on in my
$800 a
area.
month. That's a deal breaker for some
Whew.
people.
It's in my area. It's 1.6.
Jeez.
See, 1.6 is a great tax rate.
No,
Yeah, but still,
Just mud.
that's mud.
Oh, your
Yeah.
mud. Oh, yeah. See, that's bad.
Your mud.
Well, Katie's got high taxes, too.
Yeah, I live in Katy.
Yeah.
So it's, and then the other theory is with construction is, it's like buying a car.
Mm-hmm.
You know, if you buy a new car, you're going to pay the higher price as soon as you drive off the lot.
Done.
The value, the depreciation of that car is dropped.
Yeah.
Right.
But if you buy a used car, it's already depreciated.
Yeah.
You know, and it's the same way if you go in the neighborhood. The same example of the realtor that sold the house in my neighborhood.
Mm-hmm.
You know, it sold for $525 around there. Similar houses that were just north of 529 in Ellison,
Yeah.
they were going for $700,000. They were selling
Oh,
brand new
wow.
for $700,000.
Okay.
Jeez.
Same, and the house was improved, but it wasn't a new house.
Yeah.
Let me bring this kind of, because I always think about this too when people who buy new construction. Because my parents live down there in Lagomar. It makes sense for them. They don't have to pay the taxes.
Oh, yeah,
Because he's
yeah.
he's 100% disabled veteran. So
Yep.
that's the only reason.
Yep.
But what happens with Lagomar, and it's beautiful. I love
It
it.
is.
I'm not speaking poorly of it. I'm using it as an example. When you buy in Lagomar, that mud tax is going to be there for a long time because it is huge. They are still putting things in there. So
Yeah.
what happens if you buy new construction when the rates are at where they're at now, when that refi boom comes in a couple of years, if you didn't put a certain amount of money down, you may not be able to refi. And I say that because new construction doesn't carry its weight. Like if you buy a new construction for $350, right? And then you try and refi in a couple of years, your value actually goes down if that place is still building because it's like, why would I buy this house for $350
Yeah.
when I could buy down the street brand new
Right.
for $350?
Yeah.
Right? So that's what I mean. Sometimes, because I had that when the COVID rates dropped.
Yeah.
During COVID, I had so many people wanting to refi, and I couldn't get the equity in their house.
Well, we just saw that too with one of our
On new
realtors
construction.
in Lagomar. You know, she had a used home.
Yeah.
It was a year old, but it was previously owned.
Couldn't get the money because you.
Couldn't get the money.
That's what I'm saying. Lagomar
Yeah.
has a really hard time flipping those homes.
Yeah.
So if you're going to buy in Lagomar, because Lagomar has a turnover, and I think it's
Oh, it
because of
does.
the taxes.
It
and the
totally
HOA.
does.
It
It-
really has a turnover.
We do
And
a
we're
lot
gonna
of
go. We're
shooting.
gonna see that too.
They have
Yeah.
a
And
hard time
and it's,
getting those houses sold.
you know, it's just I look on my neighborhood Facebook page.
Yeah.
You know, always always a fun time looking at those comments. But
They're
it's
mad.
yeah, you know, and usually around like April or May, you know, when they get their reanalysis of their taxes done,
Yeah.
they're like, you know, they have what are called unimproved taxes, which is just the
Land.
the land
Yeah.
versus the improvement.
Right.
And usually it takes 2 years to get caught up.
Mm-hmm.
And then once a year and a half comes and they see what their tax bill is going to be and their payment, they're like, oh
That's a
my
deal
God,
killer.
I never saw that.
Yeah.
And that's the issue with using the builder's lender, because they are representative of the builder.
Right.
And they don't care about that long-term relationship with
Yeah.
you. And, you know, I have a hard time with it. And I see these comments and I'm like, I feel.
I had a really good friend, similar situation. She's up in Humble, and she bought a new construction home. I think she bought for like $425. And the way that they approved her was like, hey, this is what your taxes are now. We're going to approve you on this, but we're also, in order to approve you, we have to take a certain percentage, blah, blah, blah. But the taxes went way over that.
Yeah.
So she was $20,000 short in her escrow.
Wow.
Yeah.
So when you're short $20,000, what happens is, okay, we're short. We're going to prepay that for you. Okay, so you're $20,000 in the hole, but now we have to also collect on that 20 in the hole and the new $20,000 that
Yep.
you owe.
Yep.
So it went up literally $1,800.
What a
Yeah.
nightmare.
She was like, I can't do this. So she had to do the forbearance thing. And
Yeah.
I was like, God. And I told her, I said, girl, if I was telling you like you were my sister, I'd tell you to sell the house. And I know she didn't want to hear it. And I said, I'd sell the house. I would, and I would try and get a different house. But she figured it out, and she ended up staying there. But those are the things in my brain that I'm like, how is that something? How is that able to slip through the cracks like that? Because I know that's not a one-time thing. There are people who are always short on their escrow with new construction.
And that's the reason why they're short, is that it's how they're educated. You know, is
Tell them
if
to
you go
make
if you
my
go
payment
with an
what it's gonna
internet
be.
lender like Rocket Mortgage,
Make my payment what it's gonna be.
is they're, you know, it's frustrating to deal with these people because they are not giving the right advice.
Yeah.
All they're trying to do is just get you into the loan, and they're not giving you the whole piece.
Well,
And then they're done with you.
They're
Yeah,
built
they're done. They don't
They're
care.
finished.
It's a
They're
one-time
built.
transaction.
Right.
And it's you know,
They're
I had a customer where, you know, my loan was better, but what they did is they did it as a FHA loan versus conventional.
You called me on this.
And then what they did is they just made the customer feel like their interest rate was good. So they gave them a 5.5% interest rate versus mine of 7.4. But they didn't realize that, number one, is that they were going to refinance next year.
Right.
And then number two, they were charging them almost 4 points, 3 or 4 points to get that loan.
Right.
Which
right.
is expensive. That's
It's
$16,000.
just like Jen always says, I can give you whatever rate you want.
As your lender, I can give you whatever rate you want as long as there's not a fees issue.
Yeah.
But I say it all the time to people. I'm like, FHA loans will always have a lower rate.
Yeah.
Always. Because they collect a lot of money from you up front in that funding fee, which is 1.75%.
Yeah.
So basically you're paying 1 3/4 of a point. That's how I like for people to think of it. I'm like, think of it like this. You're paying 1 3/4 a point, 1 3/4 points to get that FHA rate, and you're paying the FHA mortgage insurance. Whereas if you go conventional, you have a really good credit score. You're going to get a higher rate, but your payment is going to be way less.
Yeah.
And just because you don't have that funding fee that's rolled into the loan, and you're paying less on mortgage insurance.
So
You know what I'm saying?
it's, you know, it's funny because people
always different.
people research me online, you know, and they
Do
see
they?
you see their reputation. And I think that what they need to do is they can do the same thing for, you know, the Rocket Mortgage or these internet
Oh,
lenders,
yeah.
and they can see their resume.
Well, they're made for speed.
And
That's
it's and they see these people's experience, and it's, you know, and it's the way that they want to hire. They want to hire inexperienced people that don't have a mortgage background like Jen and I have.
Right.
You know, so they're doing is they're very transactional
Yeah.
in how they do it.
And flow.
And, you know, so you get that. So then you get you know, they get that conversation about, okay, they do an FHA loan versus a conventional, and they make the borrower think that it's a better deal, but it's not.
Yeah.
Then the other thing is they don't understand, you know, Texas. You know, Texas is different.
It
know?
is.
Nowhere in the United States.
It is.
Nowhere in the United States but Texas, you have to live in the state to do a refi. You cannot do a refi. Like if you're like when I worked for Wells Fargo, you know, we were both from Wells Fargo. We have skin in the game with Wells Fargo.
Yep.
But, you know, we were umbrella. We could do anywhere. And I lived
Yep.
in South Dakota. I would, you know, move people to Texas. I could do that. anytime somebody wanted to refinance in Texas,
Yeah, you had to
can't
be
do
local.
it. You have
Really?
to live in Texas. That's because Texas is very different than any other state.
Yeah.
Well, they do that because the legalities.
And the
You know,
limits.
there's a lot of ways that you can screw up a loan here, and it's
Yeah.
going to cost the bank
Yeah.
Sure.
to have
Sure.
to pay fines.
Well, plus the cash out you can only do so often here. Like
Yeah,
in other
once a year.
states, you can
Yeah.
cash out.
It's a different world.
Yeah.
But it's more to the point of what I was talking about is,
Yes.
you know, like for instance, is out of state lenders, they don't understand mud tax because it's a
Right.
separate bill, so they don't necessarily see it.
Yeah.
They don't understand the
Wind and
effect.
hail.
Yeah, they don't understand. You know, when it comes. You know, if you're living down in Clear Lake or Katy or Richmond, you don't know the effect of the insurance.
Right. Right.
Or you don't have local contacts. You know, there's just a lot of, you know, when you get the
title. Even title is different. Like in Georgia, title
Yeah.
is paid for by the buyer. In Texas, the seller generally covers,
Generally,
you know, lender's title. So it's different.
it's
state to
different.
state.
It's different expectations. You know, and it's just having the expertise of local.
Yeah.
Yeah.
You know, and it's just it's. I think that's a thing that's not brought to light when you use the internet lenders,
Right.
or the inexperienced, the big banks. They don't have that local expertise, and that can have
An
effect. You know, it's using the builder's lender. Is what is that builder's lender not telling you? I
Right.
did a loan where the house hadn't passed inspection, but the builder's lender was going to do it. But when we found out about it, we're like, well, this isn't complete. This isn't complete. This isn't complete, as stated by the city.
Mm-hmm.
You know,
And that title company and that lender that is used by the builder essentially is it's the listing agent's person. If you think about it, like in a regular transaction, it'd be like there's a listing agent and then there's a buyer's agent.
Mm-hmm.
Using the builder's lender is like you not listening to your agent saying, hey, use this person, I have a relationship with them. Use the listing agent's lender.
Yeah.
It's like sometimes when it's that combination of my lender and my realtor speak daily, it just makes it
Oh yeah.
easier. And you know, to get off of what I was just saying on the builder stuff, even with like Rocket Mortgages, some of them are good because even when I was at Wells Fargo, I was a really good, like I had relationships, you know.
Yep.
But it's not the norm. That's right. But it's like if you don't, if it's like night and day, like your lender doesn't know your realtor and they rarely talk, it can sometimes be difficult for you.
Yeah.
Because you don't know what's going on.
Right.
But these two do, so they need to talk.
Yes.
So sometimes
I can attest to that firsthand,
That's why
and
your
I'm
realtor's
I'm
always gonna
talking to
say,
people out there that are looking to buy a
Yeah.
house, maybe now or in the future. I'm not a lender. I'm not a real estate professional
No.
in any way other than photography and videography. Okay.
Yep.
So I'm coming from the outside looking in, and I can tell you, my lender that when we bought our condo. I'm sorry, it wasn't you, but I didn't
we
know
didn't
you
know- we
then.
didn't know each other.
And
I'll
there's a
forgive you.
key there. There's a key there. I did not know you then. Okay. And I cannot tell you how easy our process was because I had a fabulous lender and I had a fabulous realtor. And key point here, I let the professionals do their jobs.
Yes.
Okay. And they said, we need this. Here you go.
Trust
I didn't say why. I didn't argue.
Yep.
I didn't all the rest of this. Hey, these are professionals. Ultimately, I'm paying them to do their
Yeah.
job. Here, do it.
Yeah.
You know, and it's so freeing. We got a great deal.
Mm-hmm.
We got a great rate. You know, these people were working. It's like you see this duck swimming across the water, and
Yep.
it looks all peaceful,
like
but
you're
the
just
little
checking in.
legs just going up
It's
like
like
crazy
it's
underneath.
like you're the boss
you know?
who's just checking in.
But I can tell you, as a purchaser, just trust your professionals
Yeah.
and use somebody that you know. For crying out loud, use a real person.
Yeah.
I can't. Never will I do business with a Rocket Mortgage. Not trying to down them in any way, but there's always going to be a person.
We're saying RM a lot.
That kind of thing. Okay, Rocket Mortgage can stand for brand X, whatever, you know. But I think there's something to be said about using somebody who
If you know somebody at Rocket Mortgage, by all means.
Well, sure.
Yeah.
But somebody who's gonna train you along the way, and you can just trust them.
And that's generally why most of my market now, because I've been in Texas for 5 years now doing loans?
Yeah.
It's been about 5 years. Actually 5 years to this month. So 2018 in October is when I moved here. So my 5 to 7 years is how long you stay in it, right? So pretty soon I'm going to have my second time home buyers, which I've had them trickle in and they use me again.
Yeah.
I don't want to find people, or I have a conscience, right?
Yeah.
If somebody has a relationship with a lender, I want that to be solid, right? Mm-hmm. So I generally will work with first-time home buyers, mostly, until they become second-time home buyers. It's like, now we've got that rapport. Yeah. But I would hope that whoever you used on your first home, right, is there's a connection there. And if there's not, make sure that the second time you have that connection, because it's kind of like they're like your banker. Right. You need to see them. You need to talk to them. They need to know if, when you get pregnant and hey, do we need to expand? Or your lenders need to know you well enough so you can call them and say hey, Jen, my wife just lost her job. I might need to dig into some equity, pay some stuff off until we get back on our feet. Whatever. Because there's so many things that we can do for you as lenders other than just purchase a home. And
it's,
so
I think there is, and I know this is easy to say, and it's advice like that. But rate is not always the most important.
Oh God, never.
It's always important. It's your pay.
Yeah.
Right. It's like working at your job. Is you can work at some of these companies and make really great money, but they work you to death. It's a bad environment.
It's not always
so it's not worth the money.
Mm-hmm.
Right.
And that's also the case with the rate. Is the rate is not always the most important. It's important. Don't get me wrong. Mm-hmm. But the question is that, okay, are you going to be able to close on time?
How much pain are you going to have to go through to get that rate?
Let's just say this. The rate is all bought and paid for by every lender out there for the same price.
Yeah.
And then how they pay their overhead and their people is how it trickles down to you.
Yeah.
So when I say you will get what you pay for, people like Rocket Mortgage that don't have a lot of overhead might be able to, or these little shops that just pop up and they give you these killer rates because there's nobody there but two people. Okay, maybe they give you a great rate, but it takes you 60 days to close, and you've had to pay to extend that rate. You're already back at point.
I think more.
You get what you pay for.
You absolutely get what you pay for, but it's like, okay,
I
is
wish
that
the rate wasn't so focused on though? Yeah.
Is what kind of communication are you going to have with your lender? Are you going to be able to talk to them on Friday night?
Right.
While you're at a high school football game, are you willing to talk to them on Saturday or Sunday?
Yeah.
Or after hours? Because I always say that it's, people look for homes when they're off work, and that's when they want to talk to you. That's number one. Also, it comes to after it closes. What's the relationship going to be? Are you going to be there to answer their calls? Because there's going to be issues.
Sure.
My loan is sold. What's going on? Why did my loan get sold?
Yeah. Who's the person that I need to pay now?
It's my taxes are messed up. Why are my taxes messed up? Why are my insurance messed up?
Yeah.
Is that
who do I call to fight my appraiser?
Are you willing to do a conference call with the lender to help them on their bills, which I've done?
Mm-hmm.
Where does that value come into play?
Right.
It's like looking at, I've got one of my customers that her husband is overseas and they haven't filed their exemptions. It's a phone call that says, why haven't you done this? And it's a question because, it's, he's military, he's overseas, and he can't change his ID. He's been overseas for a year.
Right.
And, so the question is because he's military and he's overseas, he hasn't been able to change his driver's license. So what have they been able, how are they able to do that? So I have to figure that out for them.
Sure.
I'm sure that there's a route.
Yeah.
But that's what it comes down to. It's just like if you're going to the builders lenders, what are they telling you? What are they not telling you?
Right.
Well, I have people tell me all the time too, my insurance just went up. And I'm like, well, I can quote you some right now and see if it'll help. Or, what's your deductible on it? Or what are you trying to save? You should be able to call your loan officer after you close on your house.
Yeah. And the builders lenders, they won't do that. And it's it's low hanging fruit for them, and they're but they're not incented to work on that.
Right,
They're just
right.
their job is just to get people approved and into their homes.
Right.
And it's not their job to tell them, on a new construction, it's not to tell them that you can get a 3-point inspection.
What was that thing you were telling me about Circuit City? When there's
Oh, yeah.
guaranteed pay, something happens
Yeah.
to people's
So
lives.
with Circuit City, it used to be like Best Buy, and they used to be commissioned, and they were very successful with that. But you come into the store, they were aggressive. They said, "Hey, what do you want to buy?" And then they went to salaried, and you walk into a store and it's crickets. No one is around. The
by
guy is
yourself.
guaranteed his salary.
Yeah.
So you go in there and you see 3 or 4 of the employees talking to each other,
Yeah.
and you're like, "Hey, I
Hello.
need help."
Hi.
And they're not aggressive in helping you.
Yeah.
Right.
And within a
They
year or
did,
two
yeah.
of doing that, they filed
They
bankruptcy.
did. They filed. Then that's wild. Like some people have no idea who Circuit City is.
Yeah.
I remember 'em.
I mean, Radio Shack probably same thing happened to him, but it's
Yeah.
it is. There's a fine line. Like I'm not an aggressive person at all, but I definitely want to do my best at every moment because for me, everybody counts.
Yeah.
Yeah.
Everybody
Yeah.
counts.
And it's just
So-
it's and that knowledge it should count for something, and I understand about the rate being important, but also too, this is a home.
Right.
Is that you can't be cheap when it comes to a home, because what is that going to cost you?
Yeah.
Right.
You get a great rate, but there's more to the rate than there's more to the loan than the rate, and that value has to be, how is that translated?
Well, and honestly, listen, it's always within like
They're
an 8
close.
or a 4. Like think about it. I mean, rate to me, I think of rates and rate shopping like going down the street looking for a gas station. You're like, this one's $4.98. This one's $4.96. I'm gonna go here. It's like, for what?
Yeah.
Like it's just
Yeah.
you never see gas that far off.
Yeah.
It's the same with rates. They're not that far off. They're just somebody is packaging it different
Yeah.
and they're doing different things. Probably the person at $4.86 rather than $4.88. You go inside and their water is $2.92, and over here you can get it for get 2 waters for $1. So I'm just saying
Yep.
it's like
Yep.
it's rate is a package. It is the
Never
bow
thought of it
on the
that way.
package. I mean it's a good way to look at it though. I mean
Yeah.
really truly.
Yeah.
However you want me to package this so that you think I'm giving you the best deal I can do, but I would like to just be honest with you and say this is what you're doing. Thank you. Goodbye.
Appreciate it.
Bye.
Bye.